Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. The conversation today is slated to be a pretty special one because in one of the articles that Marcellus has written on their website, they come to this very interesting inference. The lines say that contrary to popular perception, there is no negative correlation between entry price to book multiples and share price returns of Indian lenders, which means the higher the entry price to book multiple, the higher the returns. And lo and behold, all of us, most of us, if not all of us, try looking for banks and NBFCs available at a reasonable price to book multiples at all times when we want to make the investment. So have we been doing it wrong? Is there anecdotal evidence to suggest that? Well, that's the conversation that we're going to have with Pramod Gubbi of Marcellus. He joins us right now on the show. Pramod, so good having you. Thanks so much for joining in. Hope all is safe.
All well, all well. Thanks for asking. Hope all good at your end. Always a pleasure to be on your show.
Thank you so much, Pramod. It's our pleasure having you. Now, Pramod, before we get to that topic that I just spoke about, can I just ask you an initial question on whether you believe the near-term rumblings in the Indian financial landscape can alter the prices and the scenarios for lenders? Because, for example, today, there's the Supreme Court ruling on the loan moratorium case. There could be other instances, yield movements, for example, and of course, the election fever, etc. Do you reckon any of these have the power to seriously alter the trajectory for banks?
Well, of course, it does. I don't think we can ignore any of these things. The future is always uncertain. There are lots of risks lurking at any point in time, and the last few weeks have meant that there are more than one risk that we can digest. Which is why we've always believed that if you're invested in companies which are better positioned to face these risks, and remember, risks are meant to be unknown, some things that we can't see, and we don't make any sort of assumptions that we are able to predict the future. Given this inability of ours to predict the future, whether it's the Supreme Court ruling that you alluded to, or the rising COVID cases, or the rising bond yields or oil prices, any of these can happen, and none of these are under our control, and we can't be really preparing a portfolio that works in a Goldilocks situation. Instead, we need to assume that some of these risks will pan out. And if we're able to build a portfolio which can face these risks or adversities and still deliver a reasonable outcome for us, then I think we would have covered a downside and still exposed ourselves to the upside. But yes, I mean, to answer your question, I don't think we can ignore these risks at the market level. The way we've built our Kings of Capital portfolio, we are less concerned.
Okay, so but just wondering, Pramod, just for argument's sake, you don't reckon that rulings can be so adverse from Supreme Courts, right? I mean, to allow the waiver of the compound interest for all of these months or what have you would effectively mean wiping out net worths of some of the banks. It would be drastic if it were to happen, right?
Absolutely. So which is why I guess it all depends on how you're positioned. So take the Kings of Capital lenders, for example. We have 8 lenders in the portfolio. They have very aggressively provided for these NPAs already. So forget about accruing those interest income in the first place. They've actually, based on their internal estimates, as good as recognized them as NPAs, despite the Supreme Court having said that you don't have to declare them as NPAs. So to that extent, their balance sheet and the P&L is already reflecting this pain. So therefore, you've covered the downside risk from here on and exposed yourself to a potential upside surprise should the judgment go in your favor, irrespective of the judgment. Now, the question is, why were these lenders able to do it and not the rest of the banks? It again boils down to your ability to absorb these losses, right? The ability comes from your capital adequacy ratios. Most of these banks are something like 20% tier 1 capital adequacy ratios, almost twice that of the rest of the banking system. If you've started off the crisis period with a very strong balance sheet position, you're able to absorb these shocks much better and be prepared for adversities better. So therefore, in such sense, we are less worried because the provisions have already passed through the P&L. If at all, a positive surprise would mean that some sort of write-backs would happen to the P&L, and there's a lot of earnings upside. Whereas the ones that haven't provided for, simply because they started off the crisis with a very poor capital adequacy position, they couldn't afford to provide for it, and therefore, should the ruling turn adverse, there'll be massive, pain through the P&L, and also put a question mark on their capital adequacy ratios and therefore their ability to grow should the environment turn positive. So, in some ways, some of the other banks with poor capital positions actually have cut off their upside risk and exposed significantly to the downside. So, bottom line is, you can't paint every bank or NBFC with the same brush. Some of these aspects of capital adequacy, your provisioning coverage, and the prudency of the lending in the first place will mean that some banks will actually emerge out of this much stronger, and they will be much better prepared for a recovery in the economy and take market share as the economy comes back to normalcy.
And therefore, don't waste time looking at the entry price to book multiples. Yeah, Pramod, the opening line on that piece that you guys have written, which like pops the eye open, right? That less than 20% of the share price returns depend on entry price to book, and yet all of us spend hours and hours trying to figure out which is the best price to book multiple from where you buy these. Tell us a bit about this study.
Yeah, so we've done this for the broader market on the price to earnings multiple and earnings growth. We've shown that over longer periods of time, earnings growth pretty much determines much of your returns over time. The entry level P multiple has very little impact on your overall outcome. Of course, shorter time horizon, 6 months, a year, then your P multiple can make a difference. But those who are investing with 3 years, 5 years, and if you go as long as 10 years, there is absolutely no effect of the entry level P multiple. Now, we applied this same concept to the financials industry, and here the price to book multiple and the book value per share are better representatives of the bank because of the nature of the business as opposed to earnings per share or PE multiples. And we saw the same thing. So we saw that first, the correlation between the price to book or the entry price to book multiple and the eventual share price returns, whether it's 5-year, 10-year, 15 years, the R square, the correlation is as little as 25% or lower. And you can see that R square dropping over the time horizons. It's 25% for a 5-year time horizon, and it's 13% for a 15-year horizon. And then we did an interesting exercise. We sorted all the banks and NBFCs based on their price to book multiples over different time horizons at the starting point, and then we cut it right down the middle. The ones which are above the median were categorized as the high price to book portfolio, and the ones obviously below the median, the low price to book portfolio. And we compared the performance of these two portfolios, and it was startling to see that the high price to book portfolio, which at the beginning was almost twice that of the price to book of the lower price to book, consistently beat the low price to book lenders significantly. And you could see that almost all the share price returns were explained by the book value per share growth. Over 15 years' time, as you'll see on the screen, the high price to book lenders delivered a 20% share price return. 19% was explained by book value per share. There was barely a small increase in their price to book multiples. Very contrary to popular perception that some of these higher quality lenders have actually delivered better returns simply because of a congregation of investors towards a small set of stocks, and therefore their price to book multiples have expanded. That looks contrary to actual data. Now, one way to understand why this happens, perhaps more exaggerated in the case of banks and financials as opposed to normal companies, is The banks and NBFCs are capital consumptive companies, right? So they generate an ROE. Often, if they're growing faster than their ROE, they need external capital infusion to fund their growth. Now, if you are a bank with a high price to book multiple, obviously raising external capital becomes cheap, right? So you had to issue that fewer shares to raise the same amount of capital, which in effect becomes book value accretive. And the fact that you managed to raise capital at a high price to book multiple actually gives you a further boost to your book value per share growth. Overall book value, of course, improves, but because you've given fewer shares, your BVPS growth becomes significantly faster. And of course, your internal accruals add to the book value per share. So there is a very fine distinction between the rest of the market and financials, where your high price to book multiple can actually become self-fulfilling in terms of your ability to drive a faster book value per share growth and hence faster share price returns. So that's perhaps a simplistic way of explaining why in the case of lenders, a high price to book multiple can explain higher stock price returns, particularly over longer periods of time. Of course, there will be exceptions in the form of turnaround stories where you will make exceptional gains over a 3-year period should a bank turn around from being pretty badly damaged from NPAs to actually cleaning up, where at least for the 2-3 year period, the market will re-rate the bank and you will get significant upside from price to book perspective. However, at the sector as a whole, I think you're better off looking for lenders with cleaner and stronger balance sheets, with prudent lending norms, and all of which, when recognized by the market, gives it a higher price to book multiple, and the higher price to book multiple allows it to access external capital at much cheaper prices, and therefore grow its book value per share very strongly over long periods of time.
Well, so there is a simple mathematical reason to it, as you explained, so to say, if I can use that term, mathematical. But Pramod, I would presume that there is also a fundamental reason to this, right? That over a sustainable period of time, if a lender is enjoying a higher price to book multiple, that is because the market in its wisdom is wanting to reward it for some exceptional work that the lender might be doing, and therefore that itself becomes a moat for the lender, so to say.
True. So of course, the more fundamental aspect is the prudence in lending in the first place. If you have demonstrated that prudence by consistently able to recover your lendings from borrowers, and therefore accrue income, strengthen your balance sheet, and reinvest that back to future growth, this is exactly what investors would want, and investors reward it through a higher multiple, and that higher multiple allows it to access capital again and again at much cheaper levels, and therefore fund future growth on a consistent basis. The contrast, or the other side, is equally staggering, right? So if you have committed harakiri by lending very imprudently, especially in a go-go period of lending to real estate, infrastructure, power, and so on. And we all know, what period that was and what sort of banks fell into those traps. You've not only sort of destroyed capital, because that capital becomes non-productive for you. It's locked up in NPAs and potentially leading to losses given the default. You will have to replenish your balance sheet by raising capital just when your capital is being eroded and the market has punished you. So you will end up raising capital at significantly lower price to book multiples, which will mean that there's a further drag on your book value per share. In fact, your book value gets diluted as opposed to getting accretive, at least the per share level, which is what matters to the investor in the end of the day. It doesn't matter how much capital you're raising, but how much capital you're raising on a per share basis, determined by your prevailing price to book multiple, can swing your fortunes either way, which is what this data and this study is showing, that over as long as 15 years, the richly valued lenders have actually delivered significantly better returns. And you're absolutely right. That's a reflection of something that they're doing right fundamentally, which is to start with to be able to raise capital at a very low price, whether it's equity capital or in the case of banks, CASA, or in the case of NBFCs, having a very strong retail deposit franchise, or being able to command a very high respect from the bond markets, being able to raise it at very lower yields, itself give you a starting point advantage over the rest of the market. And therefore, if you're armed with very low cost raw material, which is money, you don't have to go down the risk path in terms of lending to high risk borrowers to make a high enough margin. And therefore, you can afford to select the creme de la creme in terms of the borrower base, and therefore still keep your NPAs or credit costs low, and then get rewarded by the market for from a valuation perspective, and then you go into a self-fulfilling cycle. So that's an interesting thing that came out, and very important for investors to understand, particularly in financials. While we believe this applies to the broader market, but because your valuations flow through back into the fundamentals of the company through the conduit of capital raising, it's even more exaggerated in the case of financials.
Yeah, viewers, please, I hope you understand. Pramod has explained it beautifully, but the simple point of a bank or an NBFC being able to raise money at a higher price, which actually adds the book value attractiveness and the valuation, and therefore there is a natural upside to that. I just hope you get that via this conversation. Now, Pramod, before we get to how a portfolio for something like this would work, and I think you've explained it beautifully in your article about how a portfolio of some of these high price lenders actually is tended to perform the other. But just before that, I want to ask you, I want to play the devil's advocate and ask you something. I'm using an NBFC as an example. You can choose to refer to that or just a general reference to, but right at a point of time before COVID hit us or before some other crises hit us, India's premier NBFC lender hit price to book multiples which were northwards of maybe 10 times or just around those levels. And there are so many people who said that, yes, it's good to buy an expensive lender also because they are showing the value, but don't buy egregiously priced lenders. My question to you is, while this study of yours holds very true for buying expensive lenders, would it bother you if you had in your portfolio an egregiously priced lender simply because the market likes it so much that it takes the valuation substantially higher? Would you be tempted to, at that point of time, book some profits, so to say, or are you comfortable lending a good lender ride, even if it goes up in valuations, then comes off quite substantially because you believe that over a 10-year period, things would even out?
Yes, I mean, to some extent, I don't think it's a complete black and white case where you exit or anything. It all boils down to position sizing, right? Ultimately, we are also doing, classic value investing, where we are saying that we will buy stocks at a price significantly below our assessment of the intrinsic value. It's just that our assessment of the intrinsic value is not based on a certain relative price to book multiple. Our assessment of the intrinsic value is relatively more absolute, factoring in the prospects of book value per share growth and the extent or the longevity of that growth and the consistency of that growth. All of that feeds into an excess return valuation model, which gives us, again, valuation is not an exact science, but you do get a certain range. So every time we're buying a stock at a price which we believe is significantly below its intrinsic value. If that gap between the intrinsic value and the stock price becomes narrower and narrower, we reflect that in our position sizing within the portfolio. So, for example, Bajaj Finance was part of our portfolio, has been part of our portfolio for the longest time. And in last February, March, when the crash happened, what was almost 7-8% of our portfolio became 3-4% of our portfolio. So we took a call. Has anything fundamentally changed about Bajaj Finance? Remember, it was the epitome of the high price to book multiple category. And we took a call based on everything that we've known about Bajaj Finance. We don't think anything fundamentally has changed. Of course, through COVID and lockdowns, there will be question marks on their borrowers' ability to repay. But knowing what we knew about the lender's prudence in the first place, or the ability to pick borrowers, price those borrowers in terms of their assessment of the risk. We said, the price is actually very attractive now because the gap between the intrinsic value assessment and the actual stock price is widened. So why not increase it in terms of the share of our portfolio? So we took it from as little as 4% to almost 9% of our portfolio. Of course, it did pay off well. Over the next 12 months, Bajaj Finance actually more than doubled. But it could have meandered as well. But given our time horizon of 3 years, often longer than that, we are more than happy to reflect our conviction, whether it's increasing or reducing. The case that you pointed out would have been a reducing case of conviction, in which case we would have had to trim a high price to book multiple position. But at the same time,
I was talking about Bajaj Finance only.
Exactly. So there are both sides to the story. If you feel uncomfortable that the valuation is getting significant and you want to trim it, you should be able to do the other way around also. When the opportunity arises, you go ahead and increase the position. Of course, there will be a time maybe one of these stocks will go beyond its intrinsic value, but given intrinsic value depends so much on the longevity of growth, and given very few market participants actually have the ability, more than ability, the willingness to look at longevity, we believe a lot of these companies very rarely get fully priced, very rarely get close to their intrinsic value. So the possibility of exiting the position completely will be very rare. It's not ruled out, but it will be very rare. But more likely that we will toggle the position sizing in such a way that will reflect this aspect that you're saying, that the gap between intrinsic value and stock price becomes either narrower or wider.
Okay, 2 questions, 2 follow-ups to this, if you can answer them, and completely fine if you cannot, because some would be internal things that you guys do for yourself. But in the example that you gave, that if you indeed took up the positioning in Bajaj Finance to back to about 8-9% when it was trading at those in the range which was very cheap, and then it doubled from those levels, which means that even if the others valuations would have inched up, the relative weightage of a Bajaj Finance, as secure as you are about the intrinsic value, would have gone up beyond what you normally might keep for a stock. What do you do in such a case then? Do you trim positions even if you believe that the growth is looking strong and the intrinsic value is still lower than the price is still lower than intrinsic value? Would you trim positions because of sizing compulsions, or would you let it run?
No, absolutely right. So, like you said, there are some aspects of this position sizing which is our intellectual property, and without getting into the specifics of this, I would say that yes, on the other side as well, we did trim the position because ultimately we are portfolio managers, right? We are not stock pickers alone. Stock picking is one part of portfolio management. There's also position sizing. Position sizing also factors in the relative attractiveness of other opportunities in the portfolio as well. So it is all nice to say that we'll let these winners run, but if we find that there are other opportunities in the portfolio which are relatively more attractive because the gap between the intrinsic value and the share price is significantly larger, it is prudent on our part, and it's because we act on a fiduciary responsibility to our clients. So we trim that position and reallocate it elsewhere where we see better attractiveness. So that's simplifying. Sorry,
Pramod, sorry. But my question really is that what if the opportunity or the difference between the current price and the intrinsic value is almost equal in all the components of your portfolio, but one of the components, by virtue of a fairly quick share price rise, because it got decimated or what have you, is a slightly outsized proportion, would you then, because of sizing compulsions, still be tempted to resize the portfolio components?
Sure. The sizing is completely based on fundamentals.
Okay.
Our assessment of our conviction in the extent of the competitive advantage, the sustainability of that competitive advantage, and hence the ability of the company in question to deliver sustainable earnings growth over long periods of time. Now, if over 6 months the stock price is doubled, clearly no company's fundamentals actually double in 6 months. So we'll have to reflect that. We'll have to reflect that in the positioning. Sometimes, all companies move in tandem. Actually, over long periods of time, most companies in our portfolio sort of move in tandem. But in exceptional periods like the last 12 months that we saw, which was extremely volatile, where companies like Bajaj Finance fell 60% first and then doubled after that, whereas there were other stocks in the portfolio which didn't do as much, you will see these gaps arising between fundamentals and position sizing. So it is our duty to correct those, at the same time balance out the sort of urge to churn, right? Remember, we also have the duty to keep the transaction cost very low for our clients. So which is why we've created a certain tolerance band within which we sort of reflect any sort of imbalance between the fundamentals and the stock price, or the fundamentals and the position size in the portfolio. We'll do it at relatively infrequent intervals.
I put myself on mute. Pramod, last two questions on this conversation. One, if it's possible, before we get to the portfolio outperformance, which you've enumerated in that article, if it's possible, in a nutshell, kind of, to tell us if how do you kind of arrive at your version of the intrinsic value of a particular lender? I mean, is it mightily different than what the street would be doing? Are there some slightly different components that you take into account, which maybe the street doesn't, and you're doing your version versus the street is doing its own version?
No, there are different methods. Of course, it's like I said, valuation is not an exact science. Ultimately, you'll be fooling yourself if you think that you'll be able to come out with a target price or a point intrinsic value estimate. You'll need a range, because the external scenarios or the underlying drivers for this valuation technique itself will operate in a range. By and large, we can say that Indian economy will grow at, say, 5 to 8% real GDP over the next 10 years, right? In bullish circumstances, maybe 8%. Maybe you'll have a couple of years with 4%, but by and large in that 4 to 8% range. That will obviously get reflected in a range of outcomes for the financial system in general. Remember, the financial system has a certain GDP multiplier. So the growth prospects would also vary based on the external situation, which we don't have a handle on. So therefore, a lot of these inputs, whether it's the growth, whether it's credit cost, whether it's cost of funding, margins, cost of equity could itself change. A lot of these variables have their own ranges, and therefore the outcome of the intrinsic value will also have its own range. In the most simplistic construct, all techniques boil down to one thing. How much of excess return on capital over your cost of capital can your business generate? That multiplied by the investment capital is actually the value created, right? And you take the value created for each year for long periods of time till terminal value and discount it to present value. So that's the most fundamental techniques. Different techniques have actually come out of this very fundamental technique. To each his own. Ultimately, like we say that you have to believe in what you're doing rather than figure out what others are doing. Of course, we can all learn from others, but you should have conviction in your technique. So an excess return model for financials is perhaps the simplest without having to complicate it over. You don't have to figure out 2025 what will be the sort of earnings growth or the credit costs for a certain bank or an NBFC. By and large, if you know the trajectory over the next 5 to 10 years and then reflect that in the excess return model, you're likely to get a reasonable estimate of the intrinsic value.
Got it. And finally, I guess the study that you've put in also shows that it's not just for unitary stocks. It's not just one or ikaduki examples. If you have a portfolio which comprises largely of high quality, high price to book lenders, then over a period of time, such portfolio would actually meaningfully outperform a portfolio with the lower price to book lenders. Like just resting any doubts that people may have over this being a freak incident. It's actually true for a portfolio as well.
It has. I mean, we've shown this exercise. You can replicate this exercise using your own data, but whether it will transpire equally in future, it's not necessary, right? It has happened in the past. Like I said, there will be exceptions. Let's say some of the PSU banks execute a super turnaround where there is reforms around corporate governance, reforms around the incentivization of management teams, and their behavior starts to reflect some of the better run private sector banks. Their starting point price to book multiples are so low, then you will be able to make a disproportionate amount of return if that actually transpires. But we've all known the challenges for that. There could be exceptions. There's no guarantees in the world of equities. Equities, by definition, are uncertain. What we are saying is, over the last 15 years, if you assume that the conditions that prevail are going to sustain going forward as well, you know how the high price to book lenders have delivered a better return. And we've just discussed why that happens as well through the conduit of capital raising.
Pramod, this is pretty cool. Thank you so much for doing such fabulous work, of course, and then talking to us about it. Really helps most people kind of get the other side of the equation and actually the right side of the equation. So much appreciate.
Thank you. Pleasure to be on your show.
Thank you, Pramod. And viewers, thanks for tuning in to this edition of The Talking Point.